Hi, and welcome to the next episode of Belly to Belly. And we're here today with great friend Anthony Rose from SeedLegals. How are you, Anthony?
I'm well, thank you, and delighted to be on the show.
It's great to be with you. And, our audience are all companies, growth companies who are either coming into the U.S. and expanding or U.S. companies expanding. And so kind of all about growth. And before we kind of hop into our topic today, would you mind just sharing a little bit about what Seed Legal does to help companies that are expanding in the U.S.?
Absolutely. So SeedLegals is a legal tech platform. If you're fundraising or if you need all the contracts for growing your business, cap table, all the other things that startups need, is SeedLegals as a platform for that. We started off in the UK. We're also France and Ireland, and most recently in the US. We've got more than 50,000 startups on our platform. I talk to thousands of founders. I'm here to share in a few minutes, my experience. But if you're a startup founder and you're in US, UK, and other countries, hop on SeedLegals, save a fortune compared to paying lawyers. But importantly, we've learned that being empowered as a founder to understand deal terms by seeing data on thousands of rounds is super important. Now, one of the other things we found is in the UK, founders are increasingly look to expand to the US, sometimes just to do business in the US and sometimes to move their companies to the US. That used to be insanely complicated and expensive, and we're making that dramatically easier. So if you're a UK founder thinking about US expansion, we're the folks to talk to as well.
Fantastic. So let's dive into our topic, which, you obviously have a great fluence in both the legal and the fundraising side. And I guess as you see companies that are expanding to the US, what are the big challenges that they have? Where are they hamstrung?
Yeah, well, let me start in general with growth in companies. So, you gave me the list of things beforehand we're going to talk about, and I was thinking about, what are your growth challenges? And I put them maybe into three buckets, which is company, team, and founder. So let's start with company. So I think when it comes to growth, I think the problems fall in two buckets. Number one is what I call the getting started problem, and the other one is the what to do next problem. So the getting started problem is you've had this idea, you've built it, you've launched it, and like 3 people come. And now you're stuck. Is it like one more feature? If we just add another feature, it's going to take off. And then you keep adding features and it changes nothing because you fundamentally are not building in the class of thing that people want, and you really need to pivot. So the getting started problem is a bit like you're rolling a dice. If you get it right, with some tweaking, of course, building on it takes off, and get it wrong, you have to roll the dice again until you run out of money. So it's a kind of a binary thing. But if you are fortunate and pick wisely and things take off, and your company is now doing millions a year in revenue, then you have the what to do next problem. And so you built something, things are growing, but maybe they're beginning to plateau, or maybe you've got competitors eating into your space, or technology just changes. So you've now got a choice. You can go, well, what we'll do is we'll just fire all the tech team because we've got revenue. I mean, we can get to profitability. Why do we need this tech team? And we're cruising. But, if you don't innovate, you're going to die. So you have to do something. So then you go, all right, well, what should we do? We could be a US crypto exchange. So we'll bet everything on something like super risky that could be huge or could kill us. But you would only do that if you are out of options on everything else. I mean, if you've got a great business with great cash flow, why would you bet everything on something crazy? So now you're going to pick probably more smaller incremental things. But if they're too small and incremental, then doing a local maximum. So you're in the zone here and you're going, we can increase it, but actually there might be another much bigger peak just over here. But if you look just a bit further away, and this is a really hard problem because at the beginning of the company, the getting started problem resolves itself pretty quickly. You're either going to make it or you're dead. But this problem isn't a burning problem. You can continue to build the company, albeit slowly, forever being slightly annoyed that just over that valley, the riches await, and if only we could go there. And I don't claim to know an answer to it, but I think what I'd like to do And I did this in a completely naive way, and then spoke to some people at a conference, and apparently there's a whole like business school thing for it, with a terminology around it. I like to think of it as sort of playing a roulette game or something. So you're going to place 60% of your money on the things that are your cash flow today, then maybe 30% on something that's adjacent, which could be a nice increment, but it's not a super risky bet. And then 10% on something that, hey, if it fails, it hasn't killed us. If it takes off, that's awesome. And I think by playing those 3 games, so to speak, and letting the team know that you're playing these 3 games, so the core business has to perform, the next bet, it's quite big. You really wanted to have some value from it rather than kill it. And the other one, hey, if you kill it, let's keep making more of these. Nobody gets 5 for picking those. So that's the company side of things. Then on the team side of things, your challenge is that as you grow, the team and the way you interact with them, it has to get reinvented. When you get to about 30 people, many companies have the same problem, which is your first employees have joined based on the mission. And then, the mission turns into performance, which is OKRs and tracking and so on. And they often, of course, have the ear of the CEO and the exec team initially. And then as management gets added, they know you no longer have time for them. And the third one is for the founders themselves to reinvent themselves, because in the initial stages, you're the sales guy, you're the marketing guy, you're the coding guy, you're doing everything. And then how do you build the team and stop doing that? And I have to say on that one, I'm probably doing the least well, because I still do coding and I still talk to customers, and I'm super passionate, and maybe I spend too much time on the minutiae, but I'm not claiming I've got the answer, but I'm telling what the problem is. So I hope that is
that's half the battle, isn't it? Identifying the problem.
Exactly. Hello, I'm Anthony. I've got a micromanagement problem.
Exactly. We have a 12-step program for you, Anthony. It's funny that you finish with the founder, which obviously is a critical role. We often think about ego as as a and it's something that's not talked about a lot in terms of kind of founder development, but clearly ego is really important. You would never venture to start a business or cross an ocean without some level of ego. On the other hand, it can also be something that, as you just identified, that can if you're not a continual learner, if you're not listening to whether it's a customer or the internal team or to any of your stakeholders, then you do that at your own peril, I suppose.
Yeah, and this was neatly, I think, summed up some months ago by Paul Graham in his Founder Mode article, which is, when you start a company, you're all over everything. And the founder cult and personality is important. But when it's a much larger company, the classical theory says you should step back and you should appoint managers and, let people get on with things. And the best thing you should do is, work with the team and inspire and not get involved. And, for many founders, that doesn't work because for a few reasons. One, actually, the thing they love is building product, not managing people. And secondly, the managers may not have that mission and value and purpose that your customers are looking for. And if you abstract yourself too much from the business, it starts, wandering around looking for some purpose. And there's your challenge. And how do you reconcile what you as a founder love to do and think is best with, building the team that are empowered and accountable?
I wanted to make sure I asked about the future, kind of where are we going? Yeah. What does fundraising look like? How should companies be looking ahead?
Right, great question. I wish I knew the answer, but to look forward, it's often useful looking backwards. So what's changed over the last 5 years? I'm not sure a great deal has changed in fundraising in the last 5 years, but here's something that we are inventing, which we think is going to be huge. I hope it is, which is the SAFER. So let's take a step back. Once upon a time, when you were fundraising, you had to do a funding round. You went to VCs. There was no such thing as angel investing, and you'd managed to raise a few million or nothing. And then angel investing became a thing. And the price of those funding rounds that lawyers charge, particularly in the US, is insane. You know, you can spend $50,000 or $100,000 on a funding round. It's mad. And so Y Combinator came along and said, forget all that. I'm going to give you a safe, which is essentially an IOU. It says, I'm going to give you money now, and you'll give me shares one day in the future. But safes, despite the name saying safe, are not safe. So for investors, the shares are on a never, never. They may never get shares. If the company doesn't do a funding round, they may never get shares. The other thing is investors in the US are looking for their QSBS, qualified small business stocks tax savings. Surprisingly, not everyone knows about it. And that is, if you invest in a company and get stock, and you keep your stock for 5 years, you pay no federal capital gains tax up to the higher of $10 million or 10x the amount invested. So it's fantastic. But the jury's out on whether that 5-year clock starts when you got shares or when you invested with the safe. And amazingly, the IRS has not ruled on it, despite billions being at stake. So some investors go, well, if I invest in a safe, I can only reliably think my QSBS clock starts when the safe converts. But that could be 2 or 3 years down the line. So others will sort of bank it immediately, but you know, who knows what the IRS will say. So also for an investor, if you invest with a safe, you don't have voting rights and you need these pro rata letters and so on. So for a founder, on the other side, these safes are super convenient, right? I just like download them from the internet and send it to you. But the YC post money cap safe has a zing in the tail, which is the way the dilution stacks up. Every time you issue a safe, it's just diluting you as a founder. Whereas if you've done a funding round, every time you add people in the round, it's diluting all the other investors as well. And so founders, unless they know this and think it through carefully, you know, I give you 10%, I give you 10%, I give you, and pretty soon, by the time I've got my first price round, I'm now diluted to less than 50%. I'm a minority shareholder in my own company. So we think that's mad. And so we've come up with the Safer. So the Safer is a really simple way using platform technology automation on SeedLegals to give investors stock immediately. Their QSBS starts immediately. They get all the advantages being an investor. And for founders, they don't have the stack dilution. So we think it's a win-win. And I think now going back to your question is, you know, we're going to look back in a couple of years' time and go, you know what, for like 10 years, people invested and got stock. And then for like 5 years or 7 years, people invested and crazy, didn't get stock. And now they invest and they get stock again. So, and that's because, you know, YC, not being a tech platform themselves, the solution to lawyer fees are insane and it's a lot of paperwork is I'll give you this very simple agreement.
Right.
And my solution is actually I've got a platform that makes the proper set of things way easier so you can do it more easily. So I think that's one thing that's going to, I hope, change, and I hope will change that. The second thing is obviously as the cost of building things decreases with AI, people are talking about, you know, I'm not investing as much in the technology, I'm investing in the go-to-market strategy and the traction. And so we'll see people looking for proof points. They'll want you to have built it and launched it before they'll invest, compared to taking a punt on investing to get you to launch. So I'm sure we'll see more of that as a trend.
This has been so good, Anthony. I really, really appreciate you taking the time. I know our listeners, it hits them kind of right where they live. Is it okay if I share your contact details in the description below?
Absolutely. Absolutely. Go for it. Yes, please. And you can find me, Anthony Rose, on LinkedIn or anthony@seedlegals.com. And I'm always delighted to answer any questions that people send me.
Oh, wonderful. Well, again, thank you for taking the time, and we'll look forward to talking to you really soon.
Thanks, Bill.